Welcome to the deep dive. Today, we are wrestling with a question that, it really defines modern media and the absolute pinnacle of strategic capital allocation. Is Netflix NFLX already an unassailable media sovereign, or is its recent massive strategic gamble a disastrous economic mistake just waiting to unfold?
It's the ultimate contradiction, and the answer is, I think, hiding in plain sight.
Yeah.
As of today, Monday, January 12, 2026, Netflix is trading at $89.46.
89.46.
And that price point, which is sitting, far off its highs, it hides this intense market uncertainty. We're looking at a company with a market cap of roughly $380 billion, yet it just executed this $82.7 billion acquisition of core Warner Bros.
Discovery assets. I mean, the crown jewels,
Right.
HBO, DC, and the sacred Harry Potter vault.
And here's where it gets really, really interesting. The market has already signaled its deep fear regarding this unprecedented leverage and complexity. They have punished the stock with a massive 33% correction from its 52-week high of $134.
Wow.
So our mission in this deep dive is to extract the critical insights from our source materials, the financial charts, the risk assessments, the management profiles, the merger risk stacks, all to help you determine if this correction represents a deep deal discount for the patient value investor, or if these screaming red flags, like, the timing of that insider selling, mean you should wait for a much safer, lower entry point, maybe in the 70s.
Well, we need to go beyond the headlines. We need to truly understand the economic durability of Netflix in 2026. I mean, this means analyzing the risks inherent in this complex merger execution against the backdrop of their already robust and expanding subscription and advertising engine. This is a deep dive into consolidation, into culture clash, and the sustainability of free cash flow. Okay, let's unpack this monumental shift. Part 1. Chapters 1 to 3, Business, Management, and Financials. Chapter 1. Business Understanding. We have to start at the highest philosophical level, what our sources correctly identify as the trillion-dollar question. Is Netflix, post-WBD carve-out, transitioning into the definitive utility company of the 21st century cultural zeitgeist? I mean, is it becoming as utterly essential and, price inelastic as electricity or water?
Wow.
Or is this massive $82.7 billion bet an anchor, dragging its once high-flying tech valuation down to the slow, heavy gravity of legacy media companies who historically trade at much, much lower earnings multiples?
That distinction is everything for valuation. I mean, historically, Netflix's business model was beautiful in its deceptive simplicity. It was a closed-loop subscription flywheel, attention converted to recurring revenue, which funded exclusive content, which drove more attention, and so on and so on.
Right, a perfect circle.
Exactly. By 2026, though, that simple engine has matured. It's evolved into a three-pronged, diversified media ecosystem.
Okay, let's break down that ecosystem, because the single-stream subscription narrative is, it's long dead. The core remains phase 1. Subscription revenue, the utility aspect.
Absolutely. The foundation is still the subscription engine, which now boasts over 300 million paid memberships worldwide. And for a value investor, this recurring revenue base is the most valuable asset. It provides the financial float for long-term strategic investment.
It's that predictability.
It's the predictability, a trait Warren Buffett cherishes because it's so reliable. Unlike the high-risk, volatile, hit-driven nature of traditional theatrical box office receipts, Netflix's income stream is relatively smooth and stable, and that allows for massive spending confidence.
But the major inflection point for the past few years has been phase 2, advertising, which is the new high-octane growth vector. The sources make it really clear this is not a side project. It's fundamental to future growth.
That's correct. The ad-supported tier was, initially controversial among longtime subscribers, but its maturity has been swift and profound. By late 2025, the ad tier represented approximately 50% of all new signups in the markets where it's offered.
50%, that's huge.
It is, and it's strategically crucial for widening the top of the funnel, capturing those highly price-sensitive consumers globally who were previously priced out by the standard tier.
And the margin structure on that is what's truly appealing for investors, isn't it?
Precisely. What's fascinating here is that Netflix captures the full value chain. They create their own ad tech inventory, they run their own programmatic platform, and this results in extraordinarily high margin revenue. Once the content has been created and amortized for the subscription base, every dollar of ad revenue, measured by CPM or cost per thousand views, drops almost straight to the bottom line.
It's pure profit on an already paid-for asset.
It's revenue built on content costs they've already incurred.
And then we hit phase 3, the strategic pivot, the $82.7 billion WBD acquisition. This is the moment, as the sources note, where Netflix stopped being the upstart disruptor and started executing a strategy of, well, empire building.
This is where they shift from being content creators to becoming IP hoarders. I mean, they weren't acquiring a struggling company. They were strategically carving out the most valuable assets, the crown jewels. They're culturally irreplaceable.
So what are we talking about here?
Well, this includes HBO and HBO Max, bringing the undisputed kings of prestige under their roof. Think the established cinematic quality of The Sopranos, the global phenomena of Game of Thrones, and the modern critical darling Succession. They also acquired Warner Bros. Pictures, the massive studio infrastructure and essential creative relationships, which provides a guaranteed pipeline.
And most critically, the sources point to the vault. This is the IP that provides genuine longevity.
The vault includes the entire multi-generational DC universe, so Batman, Superman, Wonder Woman, the globally licensed Harry Potter wizarding world, and the evergreen library staples like Friends. These aren't just shows. They are platforms for merchandising, for gaming, for long-term brand extensions. Netflix has secured content streams that don't age.
That is the shift from renting content to owning global culture. The sources provided us with the new media monolith diagram, which I think perfectly illustrates how all these pieces fit together to create a perpetual motion machine.
The diagram shows that the HBO prestige content, the massive DC IP, and the WB Studio infrastructure feed the Netflix platform flywheel synergistically.
Yeah.
And the output isn't just more streaming hours, it's exponential. It results in 3 measurable investment benefits. 1, sustained global subscriber growth. People subscribe for Potter, they stay for HBO. 2, extremely high CPM ad inventory due to precise targeting powered by richer data. And 3, critically new, massive merchandising and gaming opportunities, particularly for DC and Harry Potter. The core strategic goal here is to reduce churn to near zero and increase pricing power significantly. So if we look at the economic moat, it has just fundamentally transformed. It started as a counter-positioning moat streaming versus linear TV.
Right.
Then it moved to a scale moat, basically spending more than anyone else. And now, in 2026, it is officially the IP and data mode.
That's the unassailable position they are building. I mean, let's look at the sheer cost advantage driven by scale. With 300 million subscribers, the amortization math is truly unbeatable. If they spend 200 million on a global blockbuster film, the cost per subscriber is only about 66 cents.
66 cents. Just 66 cents. Now consider a smaller competitor with, say, 50 million subscribers spending the same 200 million. Their cost per subscriber is $4. This $3.34 difference per subscriber is Netflix's primary defensive weapon. This virtuous cycle allows Netflix to consistently spend more in absolute terms, ensuring higher quality and volume while simultaneously spending less in relative terms. It effectively crushes smaller regional players.
So that scale is the defense, but the data moat is the offense. It makes the platform indispensable.
The network effect is exponential. The algorithm feeds on every single interaction, every pause, every rewatch, every genre skipped. What the HBO integration does is add a completely new premium tier of audience data. It's not just the quantity data, but the quality.
Right.
They now know the habits and preferences of the premium prestige audience that traditionally watched more limited auteur-driven content. This creates a fuller, richer picture of the consumer, allowing for superior ad targeting, better programming decisions, and even further reduced churn, because they can predict exactly which original series will appeal to the newly acquired HBO audience.
And that leads to brand dominance. I mean, Netflix is already the default verb for entertainment globally. The combination of the sheer volume of Netflix and the established prestige of HBO effectively creates a super bundle that, for the casual viewer who doesn't want 5 separate subscriptions, truly eliminates the need for any other service.
And that market dominance ties directly into the industry trends we have to consider. The sources argue compellingly that the streaming wars are fundamentally over. We are now firmly in a consolidation phase, settling into a stable oligopoly.
The new structure is brutal and clear. the leader, which is Netflix consolidated HBO with its massive scale and IP, the challenger, Disney plus Ode, which has its own generational IP moat, and then the tech utilities, like Amazon and Apple, who don't rely on media for their core profitability, and then finally, the victims.
The victims. These are the regional or legacy players, Paramount, Peacock, others, who are folding, selling, or consolidating. The critical implication for you as an investor is that consolidation always improves pricing power. When fewer large competitors are flooding the market with cheap, subsidized content merely to chase market share, Netflix gains the freedom to raise prices more aggressively without fear of mass churn. They're strategically buying their way into an unassailable position where they dictate the price of high-quality video entertainment globally.
Before we move on to the management team that orchestrated this massive deal, I want to take a quick second to ask you to like and subscribe to Stock Analytics AI. Apologies to all members. We have been demonetized by YouTube for repetitive content. They clearly don't understand what we are doing here. The good news is that we are going to continue. For members, sign up at stockanalytics.ai, and within the next few weeks, we will upload access to the full 600 videos for the S&P 500 and NASDAQ 100 and the coming 100 top AI stocks of 2025, $5 per month, and we will begin adding more features to the web application by the week, so joining early will be a great advantage. Chapter 2. Management evaluation. Okay, let's look at the architects of this empire. If the business is structurally sound, we turn to management. Warren Buffett focuses on integrity, intelligence, and energy. This team, it embodies intelligence and energy, but there are recent capital allocation decisions, particularly the reliance on debt and the suspicious timing of stock sales. They definitely raise questions about the integrity of their judgment regarding their own stock's valuation.
We have to analyze the three key figures and their roles in this moment. Starting with Reed Hastings, the executive chairman. He is the original visionary. He deserves credit for seeing the death of the DVD rental model and possessing the rare courage to pivot the entire company towards streaming.
The Quickster disaster.
Famously enduring the Quickster crisis, literally eating his own young to save the company. His current shift is to strategic overseer, focusing on the big picture.
But here is the massive, unavoidable red flag for value investors. Hastings' ability to shift roles is admirable, but in late 2025, just before this leverage-heavy defining acquisition was formalized, he engaged in significant insider selling, liquidating hundreds of millions in stock.
That timing is precisely why every cautious investor must pause. While executives often sell stock for portfolio diversification or estate planning, seeing the founder sell heavily right as the company reverses its capital structure, moving from share buybacks to massive debt signals. One of two things. Either he believes the valuation at the time of sale, which was above $110, was fully priced and perhaps slightly rich, or he is de-risking ahead of what he anticipates will be a potentially turbulent multi-year integration period.
And the fact that the leadership team, who know the risks better than anyone, chose to take money off the table at the highs is an unignorable caution signal.
It really is.
Next up is Ted Sarandos, the content architect. His current test isn't about content creation. It's about cultural assimilation and preserving the prestige they just paid a fortune for.
Sarandos is historically the one who made the big asymmetric bets. We remember his famous quote regarding the $100 million bet on House of Cards. If this fails, we will have dramatically overpaid.
Wow.
But if it succeeds, we could completely transform the business. That kind of institutionalized risk-taking built Netflix. Now, he faces the ultimate Karsha clash, integrating the Warner Bros. Creative culture, which traditionally honors the theatrical window, protects auteur directors, and emphasizes prestige over volume, with Netflix's own algorithmic, volume-driven, binge-release production style. The core question is whether the prestige of HBO can survive the Netflix machine without being diluted.
And finally, Greg Peters, the co-CEO and operator. He is the counterweight, the person who ensures the massive content spend actually translates into sustainable free cash flow.
Peters provides the essential operational discipline. He is the one who successfully engineered two of the most unpopular yet necessary and profitable moves in Netflix history.
The password crackdown.
The highly effective password sharing crackdown and the rapid rollout of the ad-supported tier. He is the one responsible for guaranteeing that the content expenditure translates directly into the free cash flow that value investors are now counting on. Which brings us to the core management test, capital allocation.
The sources show a dramatic and complete U-turn in their capital philosophy. From 2023 through late 2025, Netflix was in what we call the cannibal phase, aggressively buying back its own stock.
This was the period where they were acting like a textbook value compounder. They were generating so much excess cash that they could aggressively repurchase shares. In 2025 alone, the board authorized an additional $15 billion for share repurchases, returning nearly 93% of available capital to shareholders. This reduces the share count, concentrates future earnings among remaining shareholders, and increases the ownership stake of the existing base, a massive vote of confidence in their own valuation.
But the WBD deal reverses this entire philosophy overnight. They are immediately suspending those buybacks, and that cash flow has a new purpose.
The focus shifts entirely. Cash flow is now diverted to two critical areas: servicing the massive new debt load associated with the $82.7 billion acquisition and integration costs. Furthermore, the deal structure requires the issuance of new stock. WBD shareholders receive $4.50 in Netflix stock per share as part of the transaction,
Which means dilution.
which results in dilution, reducing the percentage ownership of existing NFLX shareholders. This action reverses some of those hard-won gains from the buyback era, and it forces the company to take on a significant portion of Warner Bros. Debt, which jeopardizes the hard-won investment-grade balance sheet they fought years to achieve.
This brings us squarely to the Buffett conundrum, the central tension in this investment thesis. Buffett famously dislikes high-priced acquisitions, especially those funded by debt and stock, because it often suggests management believes their stock is overvalued or that they have run out of profitable organic growth ideas and are resorting to external growth.
So the question for you, the investor, is whether this massive move represents genuine empire building, growing for growth's sake, which often destroys shareholder value, or whether it is a rare, necessary, and defensive once-in-a-lifetime opportunity to acquire the boardwalk property.
Meaning HBO and Harry Potter?
Exactly. The generational IP to secure the moat permanently against all comers. Management is clearly betting on the latter, calling it a historic alignment of assets. But the market's severe 33% correction suggests that deep skepticism about execution and debt is winning the argument right now.
Chapter 3. Financial health. If the management decision is the subjective test of strategy and integrity, the financials are the objective scorecard. Netflix has completed a profound transformation, moving from a cash-burning growth story, which was the source of constant criticism, to a reliable cash-generating machine.
The sheer stability of the mature business is undeniable. As of the third quarter of 2025, we used TTM, or trailing 12 months, data for consistency revenue reached $43.38 billion, which represents a very respectable 15.4% year-over-year increase. We need to look closely at where that revenue is generated to understand its durability in the face of macro headwinds.
The geographic breakdown tells a crucial story of segmentation. UCN, the US and Canada, is the mature core market, generating $17.35 billion in 2024. Growth here is nearly saturated, driven almost entirely by pricing power. They raise the price, and average revenue per membership goes up. But subscriber numbers don't change much.
That's right, UCAN is the utility base. The true growth engine, however, remains international. The EMEA, Europe, Middle East, and Africa region alone contributed a staggering $12.38 billion in 2024. This geographic diversification is essential for investor comfort. It protects the company from single-market economic downturns and provides a massive multi-year runway for subscriber growth that the saturated U.S. market can no longer offer. This makes the company resilient.
The most appealing aspect of the financial story, particularly for those focusing on long-term compounders, is operating leverage. This is the mechanism that ensures cash flows straight to the bottom line, despite the massive content expenditures.
It is the core thesis. Content costs, while large in absolute dollar terms, grow slower than the exponential growth of the revenue base and the global subscriber count. Once that inflection point is crossed, every new dollar of revenue disproportionately flows straight into the margin structure. Their gross margin stands at a very healthy 48.09% as of Q3 2025.
And the operating margin is the true barometer of efficiency, signaling their ability to scale operations globally without ballooning, SG&A costs.
And the operating margin has dramatically expanded to 29.14%, a massive leap from 18% just 5 years prior. This margin expansion, the increasing efficiency of their business model, is the single primary driver of the stock's historical performance. They have proven they can translate scale into profitability.
Which brings us to the metric that matters most to value investors: free cash flow. or FCF, which Warren Buffett equates to owners' earnings. For years, critics of Netflix hammered them because they were FCF negative, borrowing billions to build the initial library.
And those critics were fundamentally wrong about the long-term model because the inflection point finally arrived exactly as management promised. We can track that critical turnaround using the provided FCF chart data. Back in 2019, FCF was a massive negative $3.14 billion burn.
A huge.
Then, they successfully crossed the line, generating $1.6 billion in 2022, accelerating dramatically to $6.9 billion in 2023, and maintaining that strong level through 2024 and the 2025 TTM period preceding the WBD announcement.
That stable, massive $6.9 billion in FCF proved the critics wrong about the fundamental structure of the business. The flywheel is successfully spinning off cash.
And that stability is critical because it provides the base for our valuation. So let's talk price. At the current price of $89.46 per share, what is the market pricing in regarding future expectations?
The stock trades at a normalized price to earnings, or PE ratio, of 37.29. Let's provide some context for our listeners on that number.
Well, historically, Netflix was valued as a pure play tech stock, often trading at an eye-watering 50x to 100x earnings. So in that context, 37x is actually quite low. However, when compared to the 10x or 12x PE ratios typical of legacy media companies like WBD or Paramount, 37x is still expensive. It's pricing Netflix somewhere between a utility and a hypergrowth tech company.
And the discounted cash flow analysis reveals the intense pressure of the WBD deal. To simply justify the current $89 price tag, the combined company must grow its FCF at a sustained 12–15% annually for the next decade. That growth was decelerating before the deal.
So the WBD acquisition is the necessary catalyst designed to raise that ceiling, but it introduces massive execution risk.
Management has confidently guided for $2 to $3 billion in synergies from the merger, which means deep cost cuts, technological consolidation, and cross-promotion savings. If those synergies are fully realized, the combined entity could realistically generate $15 billion plus in FCF by 2028. In that scenario, $89 is absolutely a bargain.
But if they fail?
But if they fail to integrate, or if they destroy the HBO brand in the process, the new debt service will crush the very cash flow machine we just spent time praising. That dramatic fork in the road sets the stage perfectly for the risks and sentiment the market is currently grappling with. Part 2. Chapters 4 to 7, Market Sentiment, Ownership, Risk, and Final Conclusion. Chapter 4, Market Sentiment. We mentioned the correction, but let's dive deeper into the psychology of the market. Since the WBD deal was announced in December 2025, the market has slapped Netflix with a classic deal discount. The stock fell from a 52-week high of $134.12 down to the current $89 level, a substantial, psychologically significant, 33% correction.
That 33% drop is institutional fear translated into price action. Large, cautious funds loathe uncertainty, especially when it involves massive debt issuance and the specter of regulatory intervention. This uncertainty has turned Netflix into a fierce battleground stock among Wall Street analysts.
The bulls, like HSBC, initiated a strong BUY rating with a $107 target. They are betting that the deepening monetization strategy, specifically the ad tier and the global runway, will overcome the merger headaches. They see this sell-off as an irrational overreaction that presents a buying opportunity.
Conversely, the bears, while generally positive on the base business, have lowered their expectations. Goldman Sachs, for example, lowered their target, though still positive at $112, citing the sheer complexity of the deal, and the strong risk of the stock being dead money. They believe the price will be range-bound while the lengthy regulatory review drags on, potentially for 2 or more years.
And complicating everything is the ultimate wild card, which required careful explanation. The Paramount factor, an emerging hostile twist that creates a bizarre arbitrage opportunity.
This is a scenario where bad news for the deal could actually be good news for the stock. Paramount Skydance, backed by tech titan Larry Ellison, launched a hostile all-cash counterbid for WBD at $30 per share. This is a direct challenge to the Netflix offer.
So we have this bizarre paradox. If Paramount actually wins the bidding war and the Netflix deal collapses, NFLX stock might actually surge immediately. Why would that happen?
Because the market is primarily punishing Netflix for 2 reasons: the massive new debt burden and the dilution risk from issuing stock. If the deal fails, Netflix walks away clean, relieved of all that debt and dilution. The company reverts immediately to its highly profitable $6.9 billion FCF buyback-heavy structure, which the market loved before the announcement.
Right.
So while WBD's board has favored Netflix, rejecting Paramount's offer, the ongoing threat creates severe headline risk and uncertainty, which keeps the Netflix stock price artificially depressed at $89. The arbitrage bet is whether the cost of that uncertainty is worth the potential 45% upside if the deal successfully closes.
And when we look at the technical breakdown, the negativity is confirmed, but that's exactly what a value investor wants to see when buying a high-quality asset.
Technically, the stock is broken. It is trading significantly below both its 50-day at 91.14 and its 200-day at 95.82. The overall technical indicators signal strong sell, confirming negative short-term momentum. The value investing mantra is always to buy when the charts look awful, the news flow is negative, but the underlying business fundamentals remain sound.
And the high short interest tells the same story of deep market skepticism regarding the deal's likelihood of success.
Absolutely. Short interest has spiked, with the FINRA short volume ratio hitting a high of 32.21% in early January 2026. This means nearly one-third of the trading volume involves people betting against the stock price. This pool of short sellers represents potential future buying pressure or a short squeeze if the news turns positive regarding the merger.
Chapter 5. Ownership Structure. Moving on to ownership, Netflix is an institutional staple. It is definitely not a meme stock. This institutional fortress provides a critical degree of stability and a soft floor to the price.
Approximately 85.8% of shares are held by institutions. This concentration means there's stability. These large funds conduct deep due diligence and don't panic sell based on single daily headlines. They are patient capital.
And the big three passive giants hold a massive stake, indicating a firm, patient, wait-and-see strategy regarding the merger outcome. We're talking about Vanguard at about 8.43%, BlackRock at 7.6%, and Fidelity at around 4.17%.
Their sheer combined size means they are essentially long-term holders, providing a crucial price floor. But it's a double-edged sword. If they decide the WBD integration is failing, say, due to brand erosion or missed synergy targets, their eventual shift in sentiment could move the market dramatically against Netflix.
But we have to circle back and emphasize the single biggest red flag for the cautious investor, the one signal that screams caution: insider activity.
This is the data point that requires the most scrutiny. We saw intense, clustered selling by the top three officers in late 2025, right around the deal announcement at higher price levels. Reed Hastings sold around 233,000 shares, Ted Sarando sold about 200,000, and Greg Peters sold around 130,000 shares.
Why should the listener care so deeply about this timing?
Because management is supposed to have the most confidence in the strategic direction. They were locking in massive gains at the $110 plus levels, suggesting they either anticipated the negative market reaction and the subsequent deal discount we are seeing now at 89, or they simply determined that the risk-reward ratio of holding their stock through the turbulence was less appealing than cash. For you, the cautious investor, this should cause a personal pause. If the people who engineered the deal didn't want to hold their own stock through the integration, why should you?
And the crucial missing signal reinforces that skepticism.
The crucial missing signal is that management has not been seen buying at this depressed $89 level. When value investors see a deep discount, they want to see management rushing to the open market to acquire shares, signaling confidence that the stock is cheap. Their recent selling and subsequent lack of buying suggests their assessment of the stock's near-term value might not be aligned with the deep intrinsic value the bulls are proposing.
Chapter 6. Risk Assessment. This acquisition is the ultimate high-risk, high-reward proposition. Let's start with the largest, most existential threat outside of integration: the regulatory guillotine.
The merger represents massive vertical and horizontal consolidation, which puts it directly in the crosshairs of an aggressive U.S. government. Horizontal consolidation means reducing competition by buying a competitor's assets, like eliminating HBO Max as a direct rival. Vertical consolidation means owning both the content creation Warner Bros., studio HBO production, and the distribution Netflix's global platform.
And why does the FTC specifically care about that vertical integration?
The fear is that the combined entity could engage in anti-competitive practices, such as withholding popular content, like Harry Potter, from smaller rival services, thus choking competition. Senator Roger Marshall of Kansas has already formally warned the DOJ and FTC that the deal would constitute a major vertical and horizontal consolidation, diminishing competitive pressure.
So if the FTC decides to block the deal, Netflix faces years of litigation distraction, consuming immense internal resources. Although, as we discussed, a block deal might paradoxically boost the stock short term by removing the debt risk, but the legal battle would still derail strategic focus for years.
And we also need to consider a more subtle internal risk related to quality control and brand longevity, the AI slop risk.
The sources remind us that the Merriam-Webster word of 2025 was slop, referring to low-quality, high-volume digital content produced by generative AI.
Netflix is clearly experimenting with generative AI to cut production costs and increase volume. But this is the Achilles heel of the WBD deal. HBO built its entire identity and pricing power on the slogan, "It's not TV, it's HBO," a promise of prestige, limited-run quality, and auteur dedication. If Ted Sarandos allows the pursuit of efficiency to turn HBO content into cheap, algorithmic slop, it risks destroying the very brand equity they paid $82.7 billion to acquire. Turning the platform into its content, its AI, would devalue the crown jewel overnight, potentially leading to mass prestige audience churn.
Then there is the financial complexity of the deal itself, which the market is penalizing. We need to detail the structural risk of the good bank, bad bank split of Warner Bros. Discovery.
The structure is legally treacherous and complex. Netflix is strategically acquiring the good assets: Warner Bros. Pictures, the profitable HBO and HBO Max, DC Studios, WB Television, and the essential library assets like Harry Potter and Friends. This is the $82.7 billion enterprise value portion.
And the remaining company, the Discovery Global spinoff.
That entity takes the declining legacy assets: CNN, TNT Sports, Discovery Channel, HGTV, Food Network, TLC, and crucially, the majority of the legacy debt. This structure is designed to isolate Netflix from the declining linear cable business and its associated liabilities.
So what's the risk?
The inherent risk is structural. If Discovery Global, separated from the profitable content engine, is deemed insolvent or structurally unsound by bondholders or courts, the creditors could potentially sue Netflix to claw back value. They could argue the split was unfair or designed to evade debt obligations. It introduces a massive amount of legal ambiguity that pure subscription businesses typically never have to deal with.
Finally, let's quickly address the macro factors, specifically tariffs and trade wars, which can impact globally exposed businesses.
The risk of the U.S. imposing broad tariffs on foreign films or content is a legitimate threat that has depressed media stocks before. However, Netflix has a strong mitigating factor: its massive global production footprint. By producing content in Korea, Spain, and India, they are less exposed to a single national trade policy. Furthermore, digital data is inherently harder to tax at the border than physical goods, giving them a relative advantage over hardware-heavy tech companies.
Okay, let's pull all this together into a brief SWOT analysis for the listener.
Okay, strengths: unrivaled scale, over 300 million subs, proven pricing power, the sophisticated tech data stack, and a global brand now fortified by the HBO-DC IP. Weaknesses: the massive rising debt load they must service, the highly suspicious insider selling by the top 3 executives, the still high valuation of 37 times earnings, and the unprecedented complexity of the WBD integration. Opportunities: rapidly scaling revenue via the ad tier monetization, leveraging WBIP into massive merchandising and gaming profits, and expanding globally into untapped markets. And threats: antitrust intervention by the FTC DOJ, quality erosion from AI slop content, resurgent competition, especially that Paramount bidding war, and macro trade conflicts.
Chapter 7, Conclusion. Okay, we've analyzed the business, the management's decisions, the financials, and the overwhelming risks. Now let's put a price tag on the sovereign and deliver the final verdict, framed by the 2 extreme valuation scenarios based on the success or failure of the WBD deal.
The first scenario is the bull case, the monopoly utility. This assumes the deal closes smoothly, the full $3 billion in synergies are realized efficiently through cost cuts and technology integration, and ad tier growth remains durable.
And in that optimal scenario, what does the free cash flow look like?
The combined entity hits a confident 2028 FCF estimate of $18 billion. Using a reasonable 25x multiple, which reflects Netflix maintaining its status as a high-quality, high-margin compounder, the implied share price is somewhere between $115 and $125. That offers a very compelling 30% to 45% upside from today's $89 price.
Okay, so that's the bull case. The second scenario is the bear case, the Icarus trap. The deal fails, or worse, it closes and becomes a spectacular AOL-Time Warner-style culture disaster. Debt service eats cash flow, the $3 billion in synergies are missed, and the ad market softens significantly.
In that situation, the 2028 FCF estimate drops to $10 billion. Crucially, the market would also likely re-rate Netflix from a growth compounder at a 25x multiple back to a slow-growth utility status, applying a conservative 15x multiple. That implies a devastating share price of around $40 to $50. This downside risk shows exactly why the market has punished the stock.
That valuation range, $40 to $125, shows exactly why the stock is a battleground. Let's review the external valuation summary table quickly to provide context for our listeners.
Right. Analyst consensus, which generally prices in a high probability of successful synergies, sits at $129.95. Our Ecomote DCF, assuming a positive integration, places the value at $130.50. The technical floor, the 52-week low, is $82.11. But if you are a classic, deeply patient Buffett-style value investor seeking a wide margin of safety to protect against all this risk, you would need the stock to drop below $60, a significant discount to nearly all intrinsic value estimates.
So, after assessing the base business quality, the high execution risk, and the conflicting valuation signals, what is the final verdict on Netflix at $89.46?
Netflix is undeniably a wonderful company, trading at a fair price, but it is absolutely not yet a wonderful price for the risk-averse investor. The current $89 price is composed of the high intrinsic value of the stable pre-merger business, plus a massive built-in deal risk discount. The market is effectively pricing in a high probability of failure, messy integration, or regulatory intervention that derails the synergy targets.
So, the investor's decision here is essentially an arbitrage bet rather than a straightforward investment in compounding earnings.
Precisely. You are making an active bet that the three primary risks, regulatory blockage, cultural integration failure, and ad-tier softness, will not materialize, or will be less damaging than the market expects. If you believe Sarandos and Peters can defy history and pull off this seamless integration, and if you believe the ad revenue is durable, you are currently buying $1 of future synergistic value for roughly 70 cents.
But the true Buffett stance, given the high PE of 37x and the reliance on massive debt and stock issuance for this mega merger, suggests intense caution.
It violates his preference for simplicity and capital efficiency. He would likely stay entirely on the sidelines right now. He waits for the fat pitch, the moment when panic strikes. That might be a regulatory scare that drives the stock down to the technical floor, perhaps into the 70s, where the price offers a significant margin of safety on the base business FCF before you even factor in the high-risk synergies.
Until the massive regulatory and integration risks are fully resolved and the debt picture clears, Netflix remains the sovereign of streaming.
And uneasy lies the head that wears the crown, especially one that came with an $82 billion price tag and a massive accompanying debt pile.
That is a perfect and provocative note to end on. Thank you for diving deep with us.
Thank you.
If you found this analysis helpful, please remember to like and subscribe to Stock Analytics AI.
And remember, this deep dive is based on AI-researched public sources and analysis. This is for informational purposes only and does not constitute financial, investment, or legal advice. Always conduct your own thorough due diligence and consult with a certified financial planner.